Karen, generally speaking, a Bitcoin winter is 12 to 18 months long. And these are well understood technical features. So at 76,000 from 125,000, which was the peak, we can get to 40,000. 40,000. So if we get to this Rubicon, as Steve spoke to, which is basically being called out by Saylor because of his positions, when does the forced selling and the liquidations happen to take us to 40,000? We can get there very quickly, or more likely we're going to get there over the next 6 to 8 months.
That $40,000 line is the hook, because it flips the story from a rough week to a full cycle unwind. He is not arguing that Bitcoin is dead. He is arguing that cycles can punish late buyers, and that this market can move faster than people expect when liquidations start.
But John, we've got a crypto-friendly president, and we've got a president that is friendly for all sorts of digital coin, and this is why the market has been unwilling to bet against that. They've been cautious, even though we've had a huge downward draft here, they're still cautious that friendly policies from the Trump administration could be forthcoming. Would you bank against that?
That question is basically the bull case in one breath. Politics, headlines, and hope can keep a trade alive longer than logic sometimes says it should. But the danger is confusing friendly talk with hard policy, especially when price is already sliding.
Well, I just think, everything's tied to the Stablecoin Act, and the Stablecoin Act is still playing out. So, the president generally doesn't like actual policy and getting involved in it. He likes emergency orders. So the problem here is the crypto guys bet on the wrong guy, who has to put a stable framework into place, which is the Stablecoin Act, which is playing out.
But this is still a negotiation.
Here he is saying the quiet part out loud. If the next wave of confidence depends on rules and structure, then delays matter. Negotiations can drag, headlines can change, and markets hate waiting when they are already nervous.
I was talking to Brian Armstrong about this the other day. They want some sort of reward when it comes to the stablecoin, which would take on and challenge the deposits that you've seen at banks. So this is still up for grabs at this stage.
Oh, absolutely. I mean, the whole stablecoin thing is not stable. This is the basic problem.
That is a warning about friction. Once you start talking about challenging bank deposits, you are talking about winners and losers with influence. If the framework is uncertain, traders can pull liquidity. And that is when downside targets suddenly look less crazy.
I mean, they're trying to create demand. They tried through the ETFs, now they're trying through the stablecoin. And this is the other problem here is how long has that game played? That played out for years. And there's also a generational issue. People tired of this whole trade, tired of it because COVID's over, tired of it because there's other screenplays things to do.
When he says create demand, he is describing how narratives get built. A trade can run on excitement, but it can also run out of excitement. If the crowd starts to feel like the story is stale, the market can drop even without a single dramatic trigger.
Do you agree with some of the other commentary that's been around this? I'm thinking the global market strategist at Marex, who said that what we're seeing is an asset in search of a valuation model. There's no clear consensus on what actually drives the price of this. Does that reflect your view, or do you disagree with that?
That question matters because when people do not share a valuation story, fear spreads faster. On a bad day, everyone looks for an anchor. If there is no anchor, the chart becomes the story, and the chart can turn nasty.
Well, man, there's a thesis that I think should get more airtime in financial markets, which is called the inelastic financial markets hypothesis, which is prices in financial markets are inelastic. So you put a lot of demand in, the price goes up dramatically more than it should have. So this is really inelastic financial markets hypothesis is crypto. You talk it up, you pump it up, and you create new sources of demand, and the price is inelastic and it explodes, right? But it explodes up and down.
This is the simplest explanation for why $40,000 is not a fantasy number. In an inelastic market, buyers can push price too far, too fast. The same thing happens in reverse when sellers hit a thin order book.
So when the market gets unliquid, it's going to multiply much faster and pull away. So I think the other thing here is, inefficient and efficient markets have gone towards inefficient markets because of this inelasticity of people just chasing the same stuff, chasing too many trades, too few trades.
That word unliquid is the nightmare scenario. It is not about being right long term. It is about what happens when the exit gets crowded. That is the moment when forced selling makes the chart feel like it has a mind of its own.
Yeah, I think so. I mean, getting the central bank in on these types of trades with total inelastic markets, that would just be this massive surge in liquidity, massive surge in prices. And that would be, take it another level to higher. So this is why they're talking to the president. This is why he got on his side, because they know this story. They know they need another source of demand, and they need a big one.
He is basically describing a market that is hungry for a giant catalyst. That can be exciting, but it is also fragile. If people are leaning on a big one, then disappointment can hit hard, especially during a downtrend.
A couple of points, Karen. You said that Trump's a fan of crypto, and obviously, I think I understand that him and his family are involved, but the Trump meme coin has fallen over 90% in the last year. I just saw the last print, 4.1, I think it is. It hit $75 at its high. John, come back to us on this. I've just told the .com to have a look at your $40,000 comment, so I need some more flesh on it so they can make a bit of copy for you. Why is 40,000 the level?
This is the part where a scary target has to become a real argument. If it is just shock value, it fades. If it is grounded in the way the market has behaved before, it becomes something traders plan around.
Well, if you take, the highs out of the last cycles of tops of the Bitcoin and the lows, you're going to get a kind of a megaphone pattern, right? And so this is just calling the extension of that chart to the 40,000 for this move. That's what I'm saying.
On the way down,
all day we have been circling the same theme. This market does not move politely. It expands, it overshoots, and then it snaps back. We covered the idea of cycles, the policy bottlenecks, and the hunt for fresh demand that keeps the narrative alive. We also heard why an inelastic market can fall faster than a calmer market would.
The question is, who's behind all of his liquidity? What banks? What lending? What kind of stops does he have in place in his mind? And how does he play this out? Because he's going to talk one game and play another, right? He's a trader.
If Bitcoin really does grind down toward $40,000, do you think the biggest public bulls will hold exactly as promised? Or do you think the next chapter is quiet de-risking behind the scenes?